Right, good afternoon, everyone. Welcome once again. I'm Tumasie, Blair, the Deputy Permanent Representative of Antigua and Barbuda to the United Nations. I think everybody is fully aware that Antigua and Barbuda, along with the government of Maldives and IIED, have been pushing a very a groundbreaking initiative that potentially will transform the resilient building of small island developing states, and that is the Debt Sustainability Support Service. And so this emanated from discussions we had previously with both the Prime Minister of Antigua and Barbuda and the President of Maldives and our good friends from IIED. We were able to put forward this initiative in the Antigua and Barbuda Agenda for SIDS as a tangible outcome from the SIDS 4 conference. And so now we're looking at various opportunities that would allow for the enhancement of the DSSS. We understand through various conversations that we've been having regarding debt that the issue of reforming the credit rating agencies is critically important for the successful implementation of the DSSS, not only for SIDS, but also for the developing countries. And so we really want to push this initiative, not just for small island developing states, but for other vulnerable group of developing countries. For example, the LDCs, and both Ritu and I, we're making a presentation tomorrow to the LDC group on the debt initiative. But the credit rating, reform of the credit rating agencies is critically important for us. I think many of you may not have joined the opening session for the second committee, but we had a keynote speaker at that session, Professor Jeffrey Sachs. And most of the discussions during that discussions was around credit rating agencies, the reform of the credit rating agencies, and how important that reform is within the UN system, but also how that reform would lend for the resilient building of developing countries. And so we really wanted to have this engagement here with the multi-stakeholder community as we prepare to move on to FFD4. We are keen in ensuring that the DSSS is embedded within FFD4 as a tangible outcome, and so this is why we're having this engagement here with you. And so we will hear opening remarks by Ms. Rabab Fatima, who is the High Representative, Office of the High Representative for Least Developed Countries, Landlocked Developing Countries, and Small Island Developing States, UN-OHRLLS. Madam USG.
Thank you very much, Tumasie. Ambassador Walton Aubrey Webson, Ambassador Ali Nasser Mohammed, Excellencies, distinguished colleagues, I'm indeed very pleased to join you for this important discussion on the issue of credit ratings for LDCs and the SIDS organized by the missions of Antigua and Barbuda and the Maldives and IIED. But allow me at the outset to thank Ambassador Webson and Ambassador Mohammed for their outstanding commitment and efforts in keeping this important agenda high on the UN and other multilateral forums. Distinguished colleagues, we are just about 5 months from the SIDS conference in Antigua, where we adopted the Antigua and Barbuda agenda for the SIDS, the EBAS. A key deliverable from EBAS is the SIDS Debt Sustainability Support Service, which offers a real practical solution to the persistent debt and financing challenges that the SIDS face, and we hope that we can advance with that important deliverable. And OHRLLS has applied to be on the advisory group, and we hope once accepted, we will continue to support that important process forward. The Doha Program of Action, which was adopted at LDC 5 last year, also has ambitious commitments on debt issues for the LDCs. As we meet for this important event on financing for development, it is imperative that we address the unique challenges faced by these vulnerable nations in accessing affordable financing for sustainable development and climate resilience. The current global financial architecture places LDCs and SIDS at a significant disadvantage when it comes to credit ratings and borrowing costs. This discussion comes at a pivotal moment as we seek to transform global commitments into tangible actions to support these countries. The Antigua and Barbuda agenda for SIDS, the EBAS, and the Doha Program of Action for the LDCs offer clear blueprints to address their unique vulnerabilities and financing challenges. This aligns with the broader momentum for reforming the international financial architecture to better serve developing nations. As the United Nations Secretary General has noted, financing is the fuel for development, yet many developing countries are running on empty. This is especially true for the LDCs and the SIDS, which face severe financial constraints due to climate change impacts and high borrowing costs. The alarming rise in unsustainable debt is constraining their resilience and limiting their ability to withstand shocks. Unsupportive credit ratings have further curtailed access to affordable financing, trapping many SIDS in a vicious cycle of debt. If unaddressed, the risk undermining both EBAS, DPOA, and the broader 2030 agenda. Let me share some concerning facts and figures that illustrate the scale of this challenge. Only 13 out of the 39 SIDS currently have a sovereign credit rating. From 2000 to 2022, the average credit rating for rated SIDS fell from 9.94 to 6.87 on a 21-point scale, and this decline is steeper than for other country groups. Over 40% of SIDS are either highly indebted or pushing towards debt distress. Nearly 70% have debt to GDP ratios above the 40% sustainability threshold. And the situation is of equal concern in many LDCs. For example, Mozambique and Madagascar have very low credit ratings of CCC+ and B- respectively. To break this cycle, Excellencies, distinguished colleagues, we need a bold, multifaceted approach, and I would like to offer 5 key recommendations. First, credit rating agencies must develop more nuanced approaches that factor in countries' climate vulnerabilities as well as their investments and efforts to build resilience. This could include assessing disaster preparedness, early warning systems, and climate-resilient infrastructure. Second, we should explore creating a separate rating system specifically for climate-vulnerable nations that provides a more accurate picture of their credit worthiness when climate factors are accounted for. This could help unlock more affordable financing. Third, eligibility criteria for concessional financing from multilateral development banks should be revised to better account for unique vulnerability of these countries, not just income levels. The Multidimensional Vulnerability Index, the MVI, recently adopted by the General Assembly, can assist credit agencies to better assess the structural vulnerabilities of SIDS and LDCs and their potential for building resilience. As the interim secretariat with UNDESA, my office is committed to operationalizing the MVI and advocating for its widespread use. Last week, I had very useful meetings in this regard at the World Bank, where I emphasized the importance of IFIs to utilize the MVI. Fourth, we need innovative financial instruments like resilience bonds, catastrophe bonds, and regional risk pooling mechanisms that can help SIDS and LDCs transfer and manage climate risks more effectively. This can improve their risk profile and borrowing terms. Finally, Excellencies, the IMF and World Bank's debt sustainability analysis should systematically incorporate climate risks and the economic benefits of resilience investments. This would provide a more accurate picture of countries' long-term debt carrying capacity. Excellencies, distinguished colleagues, implementing these recommendations will require coordinated action from credit rating agencies, international financial institutions, donor countries, and vulnerable nations themselves. The upcoming FFD4 conference presents a key opportunity to advance these reforms. My office is planning a special high-level SID segment during FFD4 to launch key deliverables and strengthen engagement with international partners, and we will host a dedicated event also for the LDCs. By taking bold action now, we can unlock the resources needed for vulnerable countries to invest in sustainable development and build resilience to climate shocks. This is not just a matter of justice. It is essential for achieving the sustainable development goals and ensuring a stable, prosperous future for all. I thank you once again for this opportunity to share some thoughts. Thank you again, And I wish this meeting a very productive session. Thank you.
Thank you, Madam USG. Just to note on the Strategic Advisory Group, of course, OHRLLS is welcome to join that group, and we'll send a formal response in accepting to join the group. I think your opening remarks sets the tone for exactly where we want to go, because we understand the difficulties that SIDS are facing. You're accurate in the fact that more than 40% of SIDS have reached unsustainable debt levels, and majority of SIDS are not part of sovereign credit rating agencies, and one of the fears because of our debt overhang. And the 5 key points that you've outlined goes along the lines of what we have in our credit rating agency paper, which captures the essence of our intent with this discussion, but also on the DSSS. I turn the floor over to Ambassador Webson from Antigua and Barbuda, my distinguished Dr. Twice Ambassador. Please.
Thank you, Tumasie. I'm not sure if it's the doctor is twice or the ambassador is twice, but here we are. My good friend, USG Fatima, Ambassador Ali, my friend, Excellencies, colleagues, ladies and gentlemen, thank you for coming, and I look forward to the conversation. I bring you greetings, first of all, from the Prime Minister of Antigua and Barbuda, Honorable Gaston Brown, who would have liked to have been here and would have been here virtually, but unfortunately has been called into some other activities, and I stand in his stead. Many of you are aware of the importance of the sustainable development of small island developing states, and I am equally sure that you are also aware of the new program of action adopted at SIDS 4, the Antigua and Barbuda Agenda for SIDS, known as ABAS. The ABAS covers a range of development priorities pertaining to small island developing states. However, in this increasingly interconnected and interdependent global economic framework, the issue of debt overhang in small island developing states is a major challenge and necessitates integrated strategic action from the international community. ABAS proposes the SIDS Debt Sustainability Support Service as a strategic action point. Our small economies, exposure to the effects of climate change, and the limited capacity for economic diversification creates undue pressures on our economic growth. These factors collectively exacerbates financial instability and hinders efforts towards sustainable development and economic resilience of small islands, and these therefore attracts the propensity for increasing unsustainable debt. The DSSS, in our view, have emerged as a mechanism that can simultaneously address the mounting debt burden faced by us, SIDS, and is a catalyst for sustainable economic development of SIDS. The DSSS 4 pillars aligns adequately with the needs of SIDS in addressing unsustainable debt and present a dual benefit, alleviation of financial constraints coupled with significant advancement in sustainable growth. Friends, it is the influence of credit rating agencies with their authority to assess sovereign creditworthiness excuse me, that has the potential to play a decisive role in the economic trajectory of small island developing states. How credit ratings are derived as it relates to SIDS is important for the success of the DSS, for the success of the DSSS, and this is why Prime Minister Brown is taking on the challenge in engaging the credit rating agencies in necessary reforms. Credit rating assessment affects countries like Antigua and Barbuda's ability to assess international capital markets and determine borrowing costs and influence investors' perception of our islands. Therefore, colleagues, it is critically important that FFD4 produces the strongest outcome that enables reform in credit rating methodologies that incorporates factors that better reflects the unique challenges and potentials of small island developing states. FFD4 must also ensure reforming the broader international financial architecture excuse me, that will assist in SIDS in navigating financial complexities effectively. This involves enhancing transparency, accountability, and diversity in financial institutions and tools that are accessible to us, SIDS. A reform system would ensure that the economic assessment and the financial products are more aligned with the sustainable development objectives and realities of these small islands. Opening pathways for equitable economic participation and growth. Overall, my friends, the full importance and implementation of the DSSS and its inclusion as an outcome of the FFD4, alongside with comprehensive reforms of credit rating agencies and the international financial architecture, represents a significant opportunity to transformatively address the economic challenges faced by small island developing states. This approach, colleagues, not only offers a pathway out of crippling debt burdens, but also reinforces global commitment to fostering an inclusive, stable, and sustainable economic future for SIDS, and perhaps other developing countries like the LDCs and LLDCs. With those words, I thank you and look forward to the further discussion.
Thank you, Ambassador Webson, for drawing the connection between the DSSS and the credit rating agencies. Ambassador Mohammed, please, over to you.
Thank you very much, Tumasie. USG Fatima, Ambassador Webson, Director IIED Ritu Bharadwaj. Thank you very much for convening this discussion today. As Ambassador Webson and USG Fatima highlighted, high borrowing costs is the major problem that SIDS face in their development. And the major cause of high borrowing costs is the conventional credit rating methodology adopted by rating agencies. I offer one solution that we may wish to consider, and that solution is adopting a comprehensive climate debt forgiveness swap that promises a viable way forward. It could provide debt relief that rewards climate resilience milestones. It could also be a catalyst for removing the barriers and reforming credit ratings to reflect the achievements countries made in building their resilience. Climate debt forgiveness swap is a slightly different form of debt restructuring and that have emerged in few countries in the recent past. The debt forgiveness swap is a performance-based model that grants debt forgiveness to countries meeting specific climate resilience goals, such as expanding renewable energy, for example, or protecting biodiversity, or building climate adaptive infrastructure. The idea is to link debt relief to climate milestones. How that idea will work in practice is, for example, take any SIDS country, which may, for example, work towards achieving an ambitious target in generating 1/3 of its electricity from renewable sources in, say, 5 years' time. Under the climate debt forgiveness swap, the SIDS country could receive a specific percentage of its external debt forgiven by its creditors for achieving the milestones in renewable energy. Meeting the renewable energy milestone would unlock further debt relief, effectively financing the SIDS journey to sustainable energy without accruing additional debt. This approach would not only support their credit rating, but also reduce fiscal pressure, allowing them to reallocate savings to critical development projects. The performance-based model ties debt relief directly to achieving climate resilience goals. Climate debt forgiveness swap fits with the World Bank's push for innovative financing that avoids new debt. Unlike the bonds that we have seen, whether it's a green bond or blue bond, the bonds increase liabilities, whereas the swaps that I've just described freeze fiscal space, cutting debt, and increase climate resilience. It provides an incentive that rewards resilience efforts while also enhancing creditworthiness by showcasing measurable climate gains. Reforming credit ratings to consider resilient metrics would fundamentally change how creditworthiness is assessed in SIDS. It would offer a fairer evaluation by reflecting resilience investments and long-term stability, paving the way for sustainable financing tailored to countries facing climate risks. If we recognize rewards and resilience-building efforts, we can foster a financial model that empowers SIDS' pathway forward. I thank you.
Thank you, Ambassador. So, and just to note, your proposal on debt for climate swap, I think fits perfectly in the discussion that we've been having on the DSSS, because it's a four-layered approach, and one of the layers is the approach to debt sustainability, where climate swaps also fit. And I think the difficulty that we've been having is, as we advocate for debt for climate swap, there's a hesitation from SIDS for fear of the credit rating agency downgrade. And so this is why we're having this discussion, to ensure that we unify our positions and ensure that we provide the right tools. I commend you on the proposal on debt swap, and it's something that we would advocate within the DSSS. We'll now have a presentation on the proposed approach for reforming the credit rating agency. And for those who don't know, this is Ritu Bharadwaj. She's the Director of Climate and Resilience and Loss and Damage for ACT and IIED. She has been a strong supporter of Antigua and Barbuda and Maldives in pushing for the DSSS and now the credit rating agency reform. Ritu, over to you.
Thank you so much, Tumasie. And it's really great to be here, especially talking about this initiative. And DSSS has been talked at length, but it was just at Abbas at the SIDS 4 conference itself when the Prime Minister Antigua Barbuda said that we are still missing one stakeholder around the table, and that is the credit rating agency, because without that, none of the 4-layer support that we're talking about within the debt sustainability support service would work, because it's inherently linked. So I'll just start off with my presentation. And I just thought, and I'm not trying to preach what credit rating means, but for the benefit of everyone, what does credit rating really mean? It's an indication of the credit worthiness of a country, where an investor would get a sense of whether their investment into a country would be risky or not. So by a very clear yardstick, one would say that a better credit rating would earn a country capitals at a cheaper cost compared to a country with a poorer rating. And just to give us very small context or the background about what the credit rating industry is, the credit rating itself was started by Moody's in 1909, and it's more than 100 years and still dominated by 3 big entities: Moody's, Standard & Poor, and Fitch. And they together, they control about 95% of the total credit rating industry, which means there is an oligopoly, and there is very limited incentive for these organizations or entities to modify, create diversification, or come out with any innovative product that really works well for the LDCs and SIDS. And also, there is a huge price barrier within getting credit rating. And why? Because we're calling it as income bias, and to some extent there's also a bit of where the people who are getting credit rating are paying for the credit rating services. So there is an inherent bias within that system itself, and we've heard that out of 39 countries SIDS, only 13 have it, and there are a lot of barriers to achieving that. And some of them is, one, very high cost required for credit rating. 2, even maintaining credit rating is it requires a substantial administrative effort. You have to constantly provide data, records. Every time the credit rating analyst asks for reports, you have to keep supplying them data. And that's a substantial effort. And developed countries are able to engage entities who maintain very good investor relationship with these credit rating agencies, which means that they're able to convey their credit stories more effectively. And you can't really say that out and loud, but that does translate into getting better credit rating compared to the smaller and financially constrained sovereigns. And this has been talked about by USG, where she mentioned about the way in which the credit rating has really dropped. You can see on the slide there, it's the credit rating trends of developed countries, developing countries, LDCs, and SIDS. If you see, SIDS started almost close to the developing countries, and there's more than 3 percentage points. That's the highest fall in credit rating compared to any other developed country grouping. And we have seen that from our past credit rating reports that this downgrade has consistently also been because of the climatic impact. So what we did, we tried to understand these are not the complete list of methodologies. Again, there's another factor, is credit rating entities are not really very transparent about the methodologies they use, the level of weightages that they assign to each and every indicators. And I'm sure Shari is much more accomplished than me in that area to really talk about that. But what we did, we came out with 4 areas that they typically give higher weightage to, and we try to understand to what extent they get impacted by climatic impact. So one is susceptibility to risk. I'm just going to quickly skim through some of these slides because we have talked about this in the past, but this graph clearly shows that in the last 20, 30 years, the intensity and the frequency of these climatic impacts have increased by more than 300, 200 times. And it's not just the increasing intensity and frequency, the disaster-related damages that SIDS are suffering is also increased tremendously. In fact, SIDS account for 2/3 countries globally which have the highest average annual losses because of climatic disasters compared to their GDP. Now, you can imagine that every time they're hit by a disaster-related damages, they have to borrow more debt to recover from that or even bring the economy back on track. So we compared the external debt in high disaster intensity period compared to low disaster intensity period, which increased from 45 to 58%. Similarly, if you look at, and that has a detrimental impact on the SIDS debt to GDP ratio, where almost 40% debt, you can see, is almost either pushing towards debt distress or highly indebted countries. And in fact, six countries have their debt to GDP ratio more than 100%. Now, some of the other factors that they use for credit rating is fiscal balance. Again, fiscal balance deficit or positive. And we've seen that the deficit of countries have increased from minus 2.8 to minus 4.5. This is average of 33 SIDS, from low disaster intensity period to high disaster intensity period. Similarly, tax revenue volatility, as you can see, is very high for both LDCs and SIDS. It's very clear because every time they are hit by a disaster, the economy comes to a standstill, which means their revenue, there's a huge fluctuation in their revenue collection. And similarly, private sector debt increased from 6 to 35% from low disaster intensity period to high disaster intensity period. Now, when you see this, now, of course, all of this, if you are using, if a credit rating entity is using all these factors, it means that every time SIDS are hit by disaster, their credit rating goes down. And you can see the vertical blue lines are the years when they were hit by disaster intensity more than 1. And clearly, you can see there's a downward trend in the credit rating. We also employed a synthetic control method, and we've done that for several SIDS. But we are just going to show a few data here. You can see the orange dotted lines are the credit rating that these countries would have had they not been hit by a disaster, which means that these countries are suffering or their credit ratings are going down only because they are being hit by disaster. Again, the orange dotted line that you see vertical, that's the year when they were hit by disaster intensity more than 5, and that's where their credit rating fell compared to where it should have been otherwise. Similarly for Belize. Now, the problem is, had it been something which happened once and then ended, it was a different issue. But clearly, the disaster intensity is increasing. You can see in the last 3 decades, it has increased consistently, and it's going to increase more in future. And we then simulated, only for the 13 SIDS for which we had the credit rating, as to what this credit rating would look like if the same likelihood of disaster intensity was to continue in future. If you just look at the average SIDS credit rating, it falls from 6.59 to 3.57. Again, just for clarification, typically the credit ratings are given as in letters, AAA, BB minus, but there's a World Bank assessment which has converted these letter ratings into numbers, and we have used the same conversion factor here. Now, the point is, when the credit rating entities do not adequately discount the impact of climate impacts from factors like physical and economic assessment indicators, then they are penalizing the small island developing states, and I would also say LDCs because we've looked at their data as well. And that's against the climate justice because, one, SIDS have not contributed to emissions. But two, because of their declining credit rating, they are not able to get the capital they need to invest in resilience building effort, which would then protect them from the future climatic impacts. So what could the solutions look like? Now, one solution that we are saying is that the credit rating entities, they only assess the risks to investment. So even if I have a pot of money and I want to go and invest somewhere, I would look at both. Of course, I would want to look at the risks, but I would also want to look at the return on my investment. What are the opportunities? And only when you present both the risks and opportunities can you provide a more holistic assessment. And that's why we are proposing that apart from all those traditional risk assessment framework, there's also a need to include the opportunities of resilience investment, which should include physical capital, human capital, and just quote some data here. For example, there's an assessment that Caribbean itself has about 30,000 megawatt of renewable energy. Again, there's $5 billion US annual fish production value in Pacific Islands, and that area. Again, there's a ADB assessment which says that if ports were to be developed, the trade could increase by 20 to 30%. And needless to say, in many of the LDCs and SIDS, the human capital is immense in terms of the skilled manpower, in terms of higher education people. And that's the kind of assessment you should do. So if you have to set up a renewable energy investment in small island developing states or LDC, it would give you much better return on investment compared to doing that in Germany or France, purely because of all these other enabling factors. So why are we not presenting that complete assessment? And we are also proposing that there should be we should be disrupting this market. I mean, I'm not talking about all the investment, but there should be a credit rating entity set up under the aegis of UN, which covers only, if they can only cover the resilience investment opportunities. So, and a credit rating that would give investors a sense of where the credit rating, where their investment would give them better yield or better return on their investments when it comes to resilience. We are also, we heard about MVI. Even on the risk side of matrix, we are saying that instead of the traditional risk assessment, they should be covering the predisposing, precipitating, and protective factor. Because unless you combine, I'm not going to take you through all of that. We have a paper, and but the point is, unless you look at the MVI more holistically, taking that MVI approach and look at risk more holistically, you cannot really cover all the risks aspect. Then we just didn't do that. We also simulated as to if both the resilience investment and the future protection measures were included, how would the credit rating of SIDS look like? And this is how we expect it to change. And then this is what the impact it would have on the growth. So it's almost like if you can see 2 percentage point increase in the growth of SIDS. Again, there's a third, something Tumasie mentioned, and what Ambassador Ali also mentioned about bringing in debt restructuring or debt swap and similar efforts. But the problem is, we have seen in the example, we were looking at the data, we looked at the data of Grenada, where despite all the positive economic and fiscal indicators, just because they went through a debt restructuring, their credit rating was downgraded. So that's the reason why countries who would want to undertake these disaster relief measures, they are not going for it because of the fear of credit rating downgrades. Where we want that instead of looking at negatively, it should be looked at more positively as a proactive measure being done by a country to protect or maintain its economic growth. So that's the third recommendation that we have from our side. And we worked out how the credit rating would improve if different debt relief measures were employed by countries. And this is how it would change from 6.59 to 8.42. Again, this is the level of impact it would have on its growth. It's almost like 2.4 percentage point increase in growth. Then we heard about how there's an inherent income bias in terms of generally even getting a credit rating. So there are 2 points. One, getting a credit rating itself, and two, maintaining it. They're both high income, like they're very high investment propositions. So what we really need is to break some of those barriers. And for example, the cost of obtaining, we need to bring in a tiered pricing model where LDCs and SIDS should be provided credit rating at a much cheaper price, or maybe IFIs and MDBs could provide subsidies to offset some of the costs related to the rating. Then again, we are requesting for a simplified data submission process, because that's a really tedious process. Only bigger countries which are able to engage those services, they're able to constantly provide those reports that are needed to earn a good credit rating. Then we're also expecting that, in today's the age and era with all the AI around, why are we not using technology to source some of those data, reduce some of the requirement for recurring submissions? And then we also, something that we are doing within the DSSS is about targeted capacity building, so that it can build the capacities within the SIDS and LDC to improve the ability to navigate through this credit rating process. And on this slide, I've just tried to summarize all the suggestions or recommendations from our side, which is one, creating a new credit rating entity probably we'll urge the UN to house it within its domain, within its aegis, because that would give it the kind of neutrality that it's needed. Again, assessing, enhancing the accessibility and fairness of credit rating. Two, we are requesting the credit rating approach to look at both the risks as well as the opportunity side and come up with a better rating mechanism only looking at the resilience investment, adopting an MVI to assess risk, and then finally incorporating disaster-related debt relief mechanism as a positive outcome rather than as a negative outcome. And this is just to show that all of this would have a very positive impact on credit rating. These are simulations done. And this is the level of growth that each of these measures would help in improving the growth rate. We have just used this as a proxy indicator, but at the moment you improve the growth, then it has an impact on achieving the SDG and other parameters. And I'll just leave you with this, because this is what the DSSS stands for, the Debt Sustainability and Support Service, which talks about layered approach to debt sustainability, future protection through insurance-linked anticipatory response. Third is legal and advisory capacity building support. And the fourth is around bringing in resilience investment. So if you are interested as to how we came up with that simulation and growth and everything, we have this paper, and you can always get more details from there. So back to you, Tumasie.
Thank you, Ritu, for a comprehensive overview of the type of reforms that is needed with the credit rating agencies, especially in support of SIDS and LDCs. I'm happy that some of my developed partners are here as we go into negotiations on FFD4. Just to note that this is one of the issues that not only G77 is putting forward, but I think AOSIS also is on the same trend that we need to reform the credit rating agencies. Antigua and Barbuda did submit comments to the co-facilitators on FFD on credit rating agencies, and so you would see some of these elements probably reoccurring in our negotiations. I do like the talk of perhaps a UN entity that would have a wider mandate on credit rating agencies, and this goes into the conversation that we will have with our dear friend Sherry Spiegel, the Director on Financing for Sustainable Development Office in UNDESA. And so, Sherry, welcome. It's always a pleasure when you join our discussions. We always look forward to having conversations with you. Your knowledge is far-reaching, and it's always important for you to engage with small states like smaller and developing states, and also with LDCs. And so perhaps I'll just start with throwing a question out to you. And if you could, describe the challenges with credit rating agencies in the context of SIDS and LDCs, and especially given the current climate crisis that we're facing. But perhaps maybe before that question, I think also there's a recognition coming out of the COVID-19 pandemic when the World Bank and the IMF offered some relief measures, the DSSI and the Common Framework. A lot of countries were hesitant to take on board these offers just because of the fear of downgrade from the credit rating agencies. And maybe you could speak on that at the latter end, but perhaps maybe the challenges that SIDS are facing, you could probably then come in on that issue also.
Great, thanks so much. And thanks for inviting me. It's really a pleasure to be here, and thanks to Antigua and Barbuda and Maldives for organizing this and inviting me. Apologies for my messing up. So it's, and I want to just start by saying that the question of the question of debt is, there's been a big it's preeminent in FFD4. Let's just start with that. And there's also been a big shift from beforehand, earlier, just a year ago, when everybody was only thinking about restructurings and the common framework, to now really recognizing the issue of fiscal space, and that countries that have without the fiscal space to invest, the best way to get out of a debt crisis is to grow. The best way to grow is to be able to invest. You can't invest when interest rates are so high. And if you look at SIDS and LDCs, I think that a proportion of public budgets going to finance debt, to financing for debt servicing, is the highest it's been since the early the days of HIPC in the early 2000s. I think on average, LDCs pay around 15% and SIDS pay around 17% of their public budgets. But of course, some countries pay much higher than that, up to 70% in some countries. So you can really see that the cost of borrowing is really impeding the ability of countries to invest in the SDGs and in their future growth, and in resilience, particularly in the case of SIDS. So sovereign credit ratings, and it goes beyond that. There's actually the second piece that affects private sector activity. So that the impact of this means that interest rates in the countries are very high, and there's a private sector ceiling on credit ratings, and so private companies can also not borrow at rates that they can invest in. So this impact goes beyond just the public budget. It's also to the private business activity. And so in terms of sovereign ratings, the first thing I would say, just to add to Ritu, your really great analysis, is that sovereign credit ratings in general for corporates and others are much more data-based than for sovereigns. Sovereigns have a much higher degree of the analyst's discretion than corporates and other types of credit ratings. And so that, of course, can lead to biases, whether they are conscious or unconscious biases by the rating analysts. And I will say, because some of you know I used to invest, and it's when I was investing, I was told, and this is more generally than just SIDS or LDCs, or SIDS, but I was told that if you get 60%, if you're right 60% of the time, you're beating the market. And yet we are expecting the analysts who are bringing their discretion into this thing to be right 100% of the time. And when they're not, it can affect the country and affect people in the country, impact poverty in the country, and yet it's an impossible task. They can't do it. So, I mean, they can never, it's just not going to happen. So when you have this high level of discretion, it can just lead to certainly the perception of bias, and there's also evidence that there's a bias particularly toward developed countries. So that developed countries seem to get a benefit of the doubt with rating agencies that developing countries don't get. And along with that, I would say that another really interesting factor, again, this is more than just SIDS, but it's just in general for sovereigns, that as a result, sovereign borrowers pay a much higher risk premium than any other type of asset class. And if you look historically, certainly since the period, but historically all the way back, but certainly since the period of when you've had bond markets, that the best performing asset class, adjusted for risks, after adjusting for defaults, after adjusting for all types of risk measures, is sovereign bonds. That they pay the investors the most of any other asset class over a period of time. And it just goes to show that that means that governments and people are paying investors too much. And there's a problem with the way that the markets are working in general. And ratings are part of that process. So ratings, it's very hard to know where the problem is the ratings, where the problem is the markets. But the whole point of ratings is to address a imperfection in markets where markets don't have enough information to go against, to make markets work better. And instead, all the evidence shows that they're exacerbating market problems. So they're really not playing the role that they need to play in the system. So that's sort of the overview in general. So when we get then to the question about some of the particular issues with SIDS in general, SIDS specifically. So there was a year, the second thing is that ratings are relatively short term. So the time horizon of the raters is, they say it's 2 years. We actually know it's really, if you look at the data, it's actually probably shorter than that. And yet, if you want to, so there was a time when they weren't incorporating either climate risks, because they seemed too long term, or incorporating certainly the investment in resilience. In the past few years, they've started to incorporate climate risks, and you can see that in some of the data that was shown, but they certainly don't incorporate the investments in resilience. In fact, they don't incorporate that at all, because they look at, whereas if you were investing in a company, you would look at the assets and the liabilities of the company. The ratings, because it's a government, they look at the fiscal account. That's just the balance. That's just the what's it called again? The expenditures. They're not looking at the assets of the country at all. And so if you invest in the assets, that's not part of, or not at all, but it's not part of the main focus of it. They're, of course, looking at it to an extent, but it's not part of the main focus, and particularly because they have a short-term focus. So that this call for looking at that Ritu described so well and showed some of the data, and looking at investments and resilience and how that improves the credit rating of a country is just not being done because of the short-termism, because it's not part of the way they tend to look at this, and it's linked to the short-term nature of their growth models. So that's a piece. And now the IMF, for example, in debt sustainability analysis, is beginning to think about, they're in the early stages, but they're thinking about how do they incorporate this into DSAs. But it's not yet close to thinking in the rating agencies, as far as we know. So I'd say that that's one of the main things. I'm talking too long, but I'll get to the question. Right. So I'll get to the point that you said on the question of debt swaps. And the question you asked about, which was actually going to be my next point anyway, about DSSI, et cetera, which so certainly there was one rating agency, this was the debt suspension initiative of the debt service suspension initiative of the G20, and the G20 invited the private sector to participate, but there was no forcing them to do so. And countries that meant that, first of all, not a single private sector entity participated. But any country that went into DSSI, it improves your debt sustainability, right? It improves your ability to repay everybody else if you have a debt suspension when you don't have liquidity. But nonetheless, the rating agencies, particularly one, threatened to downgrade countries that joined DSSI. Now, the reason that they did that, and it doesn't make any sense whatsoever, the reason that they did that was that they have and this links to the question of debt swaps as well. So, and Ritu also mentioned this. So I also think your debt swap program is exactly the type of program that's necessary. But there's a risk that the rating agencies have a thing called selective default. And so when a country misses its payments to private creditors, not to the public sector, so the public sector is not part of this, so you can go to the common framework of it as long as you don't default on your private sector, it doesn't. So DSSI didn't trigger a default, but they have a thing called selective default, which they say is if a country goes into default and they miss a payment, we have to downgrade them to default. And so that's part of the structure that they do this. But nonetheless, most of the debt swaps and DSSI are voluntary. And most of the debt swaps do not trigger a default, especially if it's structured in the right way. It can be structured in a way that that it's all voluntary, that the creditors all agree. Many of the debt swaps now are actually, you go into the market, you buy back debt trading at a discount, and then the sponsor that buys back the debt then makes a deal, then gives the proceeds back to the country for some investment purposes. So that should not, again, that improves the debt sustainability of the country. You're going from having a high debt service burden, taking some of that back, and then putting that investing in the country. There's no question that improves the ability of the country to repay its debt. But unfortunately, the rating agencies, and I just read an article just a week ago in the Financial Times where one of the rating agencies was bringing this issue up again. They're trying to get around the fact that they're really defaulting. And so we therefore need to try to penalize them because they really are defaulting, because they're restructuring. And it's so missing the point that these are voluntary and helping the ability of countries to repay their debt, and that they will help the ability to repay the debt going forward. So we were actually talking about maybe they need another category. Instead of selective default, when there's a voluntary restructuring, maybe call it a sustainability restructuring, maybe there's another category that could emphasize that this is a positive for the medium term, for the very next day after the debt restructuring gets into place, that it should actually help the bonds, not hurt the bonds. So,
thanks, Sherry. Maybe on that last point on another category, which perhaps could be a part of the solution, right? Are there any other solutions that you think are worthwhile for us to contemplate in moving this forward? And perhaps maybe one of the points that Ritu made, and it's in our submission paper, that some developing countries are advocating for and championing is for this whole UN mechanism of a credit rating agencies. Would that also be a part of the solution?
Yeah, so I think one of the things that we have that it gets back to this question. So yes, and I think that one of the issues is it gets back to this question of discretion. So we have called for years, and the question of transparency. So the rating agencies have become much more transparent over the past years, but it's, again, because so much of the rating on sovereigns is discretionary, it's that increased transparency is a little bit less so with sovereign ratings. And so it's harder to understand exactly what's the underlying model and where does the discretion come in. And yet the rating agencies would say that their discretion is their secret sauce. That's what makes them special. So shouldn't we understand exactly what their discretion is saying? And so the idea of having a really transparent, model-based rating that can be compared as a basis to the rating agencies, I think is really important. And the best thing would be for the rating agencies to publish that themselves. They don't, and they don't seem that they want to. So then someone else should be publishing that. And that could be a public rating agency, it could be a rating agency under the UN, or it could be a private one. I think to me the most important thing is that it be transparent, that its methodology be known, that it be subject to public discussion, and that it be something that one can have faith in and confidence in, that this is a really good thing, and that this is a really fair way of looking at this. And I think that that it's, one of these issues of when we sometimes talk about long-term credit ratings, and people say, well, how can you predict the future? And that's not what one's really talking about. One's really talking about running simulations, running stress testing under shocks, under different types of simulations, under how does this country do? And how can we rank countries in their ability to repay their debt under these different types of scenarios and simulations. So I think that type of thing would be really, really helpful, and I think it would be great for it to be. It could be under the UN, it doesn't have to be. So we're happy to say, of course, we like things under the UN, but we're also happy, it's just important to have it. That's something that's trustworthy and transparent and believable.
Thanks, Sherry. Maybe over to Ritu, because this is building on the conversation on this new entity, this new mechanism, as we're talking about. Can you identify additional core features that would represent this new mechanism and perhaps how it all fits in to working better for developing countries?
I'll just build on what Shari said. And Shari, thank you. You really brought in some very, very useful point. This whole issue about subjectivity and that discretionary element is why we want a new, the point is, either we keep going back to the Moody's, the Fitch, and Standard & Poor and keep asking them, because there are a lot of entities which have tried to enter the market, but which have failed because, there is an oligopoly, and we have not used the word monopoly because I looked at the meaning of both the words. Oligopoly means very limited entities controlling it. So maybe we can, what we are talking about is to come out with a completely new type of credit rating, because we all know there's a huge investment potential within the space of resilience. And when I say let's include mitigation, adaptation, loss and damage, everything. And then look at both the risks, of course, because if I have to put in my money, I would want to know the risks to my investment, but also look at the opportunity side. And as I mentioned before, there are so many aspects that can make the return on investment much more lucrative in a small island developing states or LDCs, purely because of the level of natural resources, human resources, minerals, and I'm not talking about mineral extraction, but all of that makes it really lucrative. But we also, as Shari was mentioning, to make it more, because credit rating itself it's shorter term. So, and that's why this is something that we want to propose through DSSS, is we want a continuous data gathering, because that's the reason why a lot of these big three entities have not allowed other entities to enter into the market, because of the historical data that they have, all the analysis and analytical aspects that they have. So we would want this entity to stay within UN, because that would give it the transparency and neutrality and would enable the investors also and the countries to have that faith that this is transparent, this is something worth relying on, and free from any prejudices or any pressure. Second, we would want that to be supported by a lot of data gathering, simulation, and analysis, which again is on transparent basis, as Shari has already mentioned. I'm probably repeating her points. But the third is to also build the capacities within the SIDS and LDCs in order to, and to the extent possible, use automation, use data generation, use machine learning, because a lot of data that many of the finance ministries have are there and computerized. So why can't we use that to simulate the kind of data or results? I think Commonwealth Secretariat did do this effort in terms of bringing together some of the debt-related data, but of course all the data is not there. So probably it would be an effort that the countries would need to do as well in order for a rating entity like this to work. But to bring about some of that simplification, but also build capacities within the countries. And I guess DSSS can play that role very well in terms of both creating a data hub as well as supporting countries manage that. So I'll just stop there, Tumasie.
Thanks, Ritu. Maybe just one other question to you, Shari, and then based on your answer, then I'll pass another question over to Ritu. I think outside of the establishment of this new credit rating agency, and we could just probably park that at the side and just talk about just the core reform itself of credit rating agencies and the influence that the UN system can have. And I say this in connection because I think we were somewhat successful in how we start looking at reform of the international tax systems. The African group really brought the pressure on, and so now we're making steps. And then, of course, SIDS with the MVI. And so, what type of support can the UN system provide member states in the reform process of credit rating agencies?
So I honestly, I don't know. is the truth. I mean, so I often am skeptical about the ability to change rating agencies. The reason why is because during the 2007 to 10 financial crisis, the rating agencies really were a major cause of that crisis. So they and this is known, so they misanalyzed the correlation of mortgages and subprime mortgages. When I was trading, it was called the trade of the century for those people who were the more parts of the market that were arbitraging this mistake. And that mistake, it has been shown, is known to have basically caused the financial crisis, the global financial crisis that hit developed country markets most. And yet, despite that, there was very little change to rating agencies after the crisis. And that was after they caused a major financial crisis in the North. So it's hard to say how much, then on the other hand, yes, we do see that efforts that have happened and started in these conversations in the UN are taking off in places and are making a difference. And there's a lot of pressure and particularly the role of the Africa group in the tax negotiations, et cetera. So I don't know the answer to it. So yeah, I think that there are forces on all sides.
But do you think, just looking at the reform of the international financial architecture as a whole, do you think that progress just from the reform of the architecture could be made in credit rating agencies, and especially as we approach FFD4?
Yeah, I would hope, if you think about that the entire financial sector is regulated, and yet credit rating agencies have much less regulation on them than most of the rest of the entire financial sector. So there's certainly an argument for saying that it should be better regulated. There's certainly a clear argument for that. Again, I don't know because I look at what happened in the past and little change happened, which is why I think we need to approach this from two tracks. One track is, yes, calling for reform, calling for discussion with them, calling on them to change, seeing if there are ways after discussions that they would be willing to change. Are there, for example, with swaps, I think that's one that it's almost a no-brainer that there has to be a new way to do this, and that's a place I think there could be space. You could imagine reforms that happen pushing for more regulation to make this more, to make it happen. And then you could also, and especially because it's an oligopoly, all industries that are oligopolies are well regulated, except not this one. So, and then at the same time, we should push for, if it's not going to happen, what measures can help support it, which is why I think that if they don't do it themselves, then one can think about other ways to have a basis that could be used to compare them to. This is about, the rating agencies are about information. And so it's in everyone's interest to have better information. And if the rating agencies are not playing their role, then the system should think about how do they get better information out there.
Thanks, Shari. Maybe Ritu. Maybe just hearing Shari's I guess indication that the success of a reform of the credit rating agency may be more of a longer term aspiration than immediate, especially looking at FFD4. Are there any steps that at least agencies like IIED and other stakeholders can propose to assist member states in how we at least advance the discussion in how we get to reform?
In fact, I'll in the process of doing this analysis, Tumasie, I probably read hundreds of papers on credit rating, and there was one very interesting paper which said how a lot of smaller entities tried to enter the market, and every time they did that, they failed, and it is because the way these credit, they wield enormous power. And that's why they have a lot of, and I'm sorry, this is on UN TV, so this is probably broadcasted. So, so there are things that I can say on record here and things I cannot. Because they wield tremendous power, which means they have inroads within the government and the way they control it. And this is an unequal financial system. The richest country, US with debt to GDP ratio of 97% still has a AAA rating. How is it possible? And can you imagine LDC or SIDS with a more than 95% debt to GDP ratio would get a AAA rating? No, they would not. So there is an inherent bias there, and it's very difficult. It's more than 100 years old industry, and people have not been able to penetrate it. So my road to reform would be, I'll still stick to the same thing. Let's disrupt the market. I'm not saying come up with a new sovereign credit rating. I'm saying come up with a new sovereign credit rating for resilience investment. Because climate finance is, you go to any climate finance negotiation discussion, and all they say is use our grants to get private sector finance. Private sector finance is not coming because there is no rating in most of the LDCs and SIDS. And more than that, whatever is there is of junk grade. So, so what Shari mentioned was credit rating is what? It's an information. So what I really see is a big role that DSSS can play, and something like if we are thinking of expanding debt sustainability support service to LDCs and other vulnerable developing countries, then that's the kind of holistic view that we could take. There's a big component within that of data collection, about carrying out like regular simulation, helping. We were thinking more in terms of supporting countries manage their debt sustainably. But the same data or analysis can also be used to provide to whichever entity agrees to host a credit rating mechanism like that, to take that forward. So, and I do see that with all the SIDS and LDCs coming together as a SIDS-led and LDC-led and owned rating system, and they all agree to provide the data transparently and with the view that UN system or some neutral entity would manage it, I think it can work pretty well.
Sure. One of the reasons for the oligopoly is just that to have a new rating agency come in, it needs to have confidence. And so the three that are there have built confidence over decades and decades, and it's very hard for a new entrant into this market. It's a natural oligopoly. It's a system that's set up that would naturally lead to an oligopoly, so it makes it harder to change. Yeah.
Thanks, Shari. I'll probably open the floor. We have limited time, but I'll open the floor for any questions. But I think maybe just one point I want to make both to Shari and to Ritu. I think in all of this discussion that we're having, I think the missing link is having a strong support system from one or two developed countries. I think they would help to move the needle on the discussions. Not too entirely dependent sometimes on some of our members in the G20, but I think what we do need is one or two developed partners who would also come and champion this with us. So I'll open the floor for Q&A. I'll give the floor first to Ambassador Mohammed, and then I'll give the floor to Sai. Ambassador?
Thank you, Tumasie. I will clarify a couple of points. One is that the debt forgiveness swap that I've been proposing is really debt forgiveness rather than debt restructuring. The bonds that we have experienced in the past few years have actually done debt restructuring rather than debt forgiveness. And this debt forgiveness actually aims at government creditors, not the private sector creditors. It may be both official and emergent creditors, but still governments. We know that from the very little information that have been made public by credit rating agencies and information about them, we know that they keep on allocating about 20 percentage points to the size of the economy, size of the GDP, and a certain percentage to outstanding external debt. In order to reduce the outstanding external debt, the swap, if a SIDS country invests in climate resilience projects or sustainable development projects or even biodiversity projects, those projects, the performance on those projects can be used as a measure to forgive a certain percentage of the debt, which if a rating agency arbitrarily uses that to trigger a downgrade, there is that risk. That is something we will have to need to explore. Something similar, as Shari mentioned, something similar happened with DSSI. I used to be based in the capital at that time and had a number of negotiations with some of our bilateral partners of the Maldives. And DSSI wasn't really a debt relief. It, in fact, helped to accumulate debt rather than repaying your debt in 2020. We ended up paying more debt in 2024. Otherwise, our deep debt repayment schedule would have given us a greater level of predictability. And at the same time, while negotiating with or discussion with rating agencies, we try in the SIDS, we try to make sure that our credibility with the rating agencies increases as we go on. And one way to increase is to reduce external debt by investing in resilience. Thank you.
Thank you. Ambassador Sai?
Yes, Tumasie, let me just say at the outset that very few of these type of meetings where I have been to be provoked, enthused, confused, and all at the same time, which is a reflection, in my view, of the topic that we're discussing and the nature of the panelists and what we are having. I want to say, on behalf of UNDESA, that the Secretary General of FFD4 has lent its complete support to this initiative and to SIDS, and wants to make FFD4 resulting in something positive for the small islands coming out from SIDS 4, of course. I want to place that on the record. Sari is here. She was in a meeting with me, and that's where I received that instructions. So to begin tomorrow, for colleagues who are around the table, there will be another event like this, and you'll probably hear from Ritu again. Those of you who do not have time to ask a question, she'll also be speaking tomorrow in an event titled From St. John to Seville. UNDESA is organizing a training for small island developing states negotiators. And we are going to do that in December. Sari and her team will be helping the SIDS unit in putting together a program as part of the department's contributions to SIDS. And we are also following very closely the discussions in COP29 when you're lending our support to the event that you're organizing. Our USG would like to make a statement there. So this is all part of that. I want to ask their excellencies, both Dr. Ali, I wanted to ask you a question, but in the discussion, the questioning that Tumasie had, Sari and both Ritu confirmed to me what I was curious about, a resilience perspective. We are building resilient prosperity, and that proposition you made, this adopting a comprehensive climate resilience measures, as you will just elaborate further on now, is fully supported. But for Ambassador Webster, to what extent has this proposition coming from IISED, Tumasie, now solidifying into being a group position for our group? It's the good points, and we would like to support it. And can you guide us how to support you, bring this mainstream to all the SIDS, and we will. And I'm looking at my colleagues sitting here from OHRLLS. We are just very eager to support. And if you could clarify that in the spirit of multi-stakeholder conversation that we are having right now.
So the issue on credit rating agency reform, from my understanding, AOSIS is keen on engaging on credit rating agencies reform, and it has landed as one of the elements in their submission to the co-chairs on the process. I think where we come in from this end is that we, meaning IIED, Antigua and Barbuda and Maldives, will begin a process of briefing AOSIS member states on the work on the DSSS, because the credit rating agency reform is key to the full implementation of the DSSS, and the workshop that you speak to in December, we have indicated that we want an opportunity to really put forward the DSSS, even though it's a commitment coming from their boss. I think we have to go down in more details so that they can understand the DSSS also. But from my understanding, it's a working submission coming from AOSIS on credit rating agencies reform also. And the elements paper, yeah. Ambassador?
Thanks for your question, Sai. I've been following the discussion overall very carefully and very keenly, and there are a couple of things. So I'm not answering your question directly. I think Tumasie has given you the answer to where AOSIS sits and the action that we are taking. But thinking of it, I think of myself more of a strategist than a financial analyst. So I believe, and the question that was raised earlier about whether the UN, we should have a new agency and so on, and I think the answer that Shari gave was quite interesting, because I'm not sure that creating a new UN entity, which opens another political discussion, is necessarily the answer. How you reform the credit agencies is more the question, and the role of governments in pushing that reform, finance departments more than the political entity, is the key push. How you get them involved, and how we do that. And I think FFD4, so it's a blend, because I think FFD4 is important, and I think having events like this that begins to build interest and begins to build a momentum is where you go towards pushing these entities like credit rating agencies towards the situation where them, with pressure from government, without totally building a new agency, but saying that you have to reform, and them understanding the reasons. So what I would propose what I would be looking at us doing is moving FFDs, moving events closer towards FFD, events like these, bringing together though, and I will discuss this more with my team, but bringing together other entities who can bring more pressure on the credit agencies so that they could begin to understand where governments and investors are coming. Because the more we are bringing investors and private sector together with the discussions we are having at the governmental level, is the better we will be able to carve out the kind of pressure that we can put on these credit agencies. It is important to strategize how we can build a sort of a triangular relationship between government, the private sector investors, and the United Nations agencies to begin to put this pressure on the government without creating another bureaucracy, but certainly building, and as we have been doing in the reform of the financial architecture, I think we are getting somewhere. We are calling and we are getting somewhere, and we're only getting there because of the pressure that the UN system and the partnership with the member states are putting on these agencies. And that's what we have to do with the credit agencies.
Thank you, Ambassador. We're about to end. Are there any additional questions? We have one video to show from Tom, who is the director of IIED, who has been instrumental also working along
for environment
with
development.
Ritu.
And I'm delighted to co-host the event
video
today.
For Tom, perhaps just to say, I think one key word or phrase that I've been hearing is the need to disrupt the market. All right, so let's disrupt the market. We have various options before us, and let us use them to disrupt the market. You could play the video for Tom.
Director of the International Institute for Environment and Development. And I'm delighted to co-host the event today. And I'm also really sorry not to be with you in person. So in the lead up to the Antigua and Barbuda summit on small island developing states earlier this year, IIED proposed a 4-part global framework for financing resilient prosperity in small island developing states. Those 4 elements: firstly, do everything that you can and use all possible measures to achieve debt sustainability around existing debt stocks. The second element, to protect future GDP losses against disasters through a global pooled insurance mechanism. Third, to be able to generate significant investment in resilience building efforts, mainly through grants, but also through concessional finance, to get out of this loop of continued losses. And fourth, to level the playing field for small island developing states in international financial systems. Because the cards are so stacked against SIDS, we need to actively change things to be able to create that better environment. So all of these 4 elements work together. They are part of a package. They cannot be treated individually. Treating them individually is a recipe for disaster in itself. So around this 4th element about leveling the playing field and also being able to generate sufficient investment, we've begun to look much more closely at the role of credit rating agencies, of credit ratings themselves for small island developing states, and we found an alarming picture. And Ritu will share the details of the research that we've done with you today, but fundamentally the credit rating of small island developing states has plummeted over the last decade. So that makes it harder to access international finance, to borrow at good rates, and in such a way which damages the financial sustainability of small island states.
All right, everyone, thank you for coming. And we have various events. If you're attending COP, we have events on the DSSS at COP. IIED will have an event on loss and damage. We're still in consultation with DESA on partnering an event. OHRLLS is having an event and various events. So we'll keep you updated on these initiatives.